Okay, so let's just jump right in. We're going to start with a question that, honestly, it sounds like a typo, but I promise you it isn't. What happens if Bitcoin drops to $8,000?
And just to be absolutely crystal clear, right out of the gate, we are not missing a zero there.
No.
We aren't talking about $80,000, which, let's be honest, that price feels like, what, ancient history at this point?
Mm-hmm.
From a few years ago.
It really does. It feels like a lifetime ago.
We are talking 4 digits,
Yeah.
$8,000.
It sounds kind of impossible, doesn't it? Like, it's like asking what happens if gravity just, I don't know, turns off for an hour.
Right.
But this is the exact scenario that Michael Saylor has thrown down. It's a gauntlet, really, to the entire financial world. He has challenged every analyst, every critic, every nervous investor to actually look at the numbers.
And the claim is just so audacious.
It is. He's saying Strategy Inc., formerly known as MicroStrategy, of course, is both liquid and solvent, even if the price of Bitcoin completely collapses to that. I mean, they have to call it a catastrophic, apocalyptic level.
It is the ultimate stress test. And frankly, the research we've got in front of us today is just fascinating because, it doesn't just take his word for it.
No, it runs the math.
It runs the math.
And we are going to run that math today. But before we get into the nuts and bolts of it all, we really have to acknowledge a bit of a time warp here.
We do.
Just 13 days ago, February 3rd, 2026, we did a deep dive into this exact company. We modeled their whole financial fortress, down to the last Satoshi.
We did. And 13 days might as well be 13 years. The pace is just relentless.
It's an eternity. Exactly. When we recorded that deep dive, Bitcoin was sitting pretty at around, what, $75,000?
Yeah, around there. The mood was, well, I'd say cautious, but definitely optimistic. The correction felt like it was maybe over.
Right. But fast forward to today, and we're seeing Bitcoin testing $68,000. It's been chopping around that level.
And that's a significant shift. The market is skittish. We're clearly in the middle of what looks like a classic mid-cycle correction, and that changes the entire context of everything we're about to talk about.
How so?
Well, when prices are high, everyone looks like a genius,
Yeah.
right? Every strategy works.
Of course.
But when prices drop, that's when you see who's actually swimming naked, as the saying goes. That's when the financial engineering gets put to the test.
And speaking of swimming, or maybe just keeping your head above water, there is a massive new variable in this whole equation.
A huge one.
Since our last deep dive, Michael Saylor went on Fox Business and just dropped a bombshell. He confirmed a plan for a massive $6 to $8 billion debt-to-equity conversion.
I mean, I cannot overstate how significant this is. This isn't some footnote in a quarterly report that you skim past.
Yeah.
This is a fundamental restructuring of the company's entire liability stack. It's a live, real-time challenge to all the critics out there who just scream about financial engineering as if it's a bad word.
So, okay. Here is our mission for this deep dive. We are going to test the Saylor claim.
The $8,000 claim.
Exactly. Does the digital fortress stand firm at $8,000 per Bitcoin, especially in light of this new debt conversion plan? But first, well, we have to eat a slice of humble pie.
We do. We've got to make a correction.
A mea culpa, if you will. Before we dive into the new numbers, we have to give credit where it's due. A very sharp-eared listener pointed out a flaw in our February 3rd model.
And he was absolutely right.
He was. We effectively double-counted the cash reserves.
And listen, this is a really common mistake in corporate finance modeling. It happens, but that doesn't excuse it. We assumed that the $2.25 billion cash pile could be used to pay the dividends and interest, keep the lights on.
Right, the operating expenses.
But we also counted that same cash as being there to protect the principal value if the company had to liquidate.
Yeah, let's just unpack that for a second so everyone really understands the gravity of it. It's like saying, okay, I have $500 in my pocket. I'm going to use that $500 to pay my rent this month, but I'm also counting it as part of my net worth in case I need to, say, buy a car tomorrow.
You can't. You can't spend the same dollar twice. It's just it's rule number one. You can't use it to pay the electric bill, which in this case represents those huge dividends on the preferred stock, and also keep it in the savings account to prove you're solvent in a liquidation event.
It's one or the other.
It's one or the other. Liquidity is flow, solvency is the balance sheet, and we mixed them up.
So the listener was right, and today we are fixing it. We are adopting a brand new rule for our model, and I have to say it is brutal, but it is much more realistic.
We're calling it the spent cash rule.
The spent cash rule, I like it.
And the assumption is this. To survive a multi-year downturn, a true crypto winter where Bitcoin grinds down and just stays there, Strategy Inc. burns the cash, all of it, the entire $2.25 billion is gone.
Where does it go?
It's used up paying dividends to the preferred shareholders, just to keep the structure from defaulting on its obligations. So when we run the final solvency test, the big stress test at the end, the cash balance is zero.
Zero. Nada. Zilch.
Which means only the Bitcoin is left to back the floor.
That is a high wire act without a net.
Welcome to the Deep Dive. I'm Satoshi.
And I'm Satoshi. So I guess, consider this the drum roll. We are rerunning our entire waterfall model with zero cash. Does the fortress still stand, or does it finally crumble?
That is the question. And frankly, this makes the analysis so much more exciting because all the margins for error they disappear.
Right. Before we get to the test, let's set the scene first. Section 1, the landscape. Where do we actually stand in the middle of 2026? Because if you just read the headlines, it really feels like the sky is falling on crypto.
It certainly feels that way if you bought the top. Let's look at the broader context. As we said, we're in a mid-cycle correction.
Yeah.
Bitcoin is trading in that $68,000 to $69,000 range.
Now, for context, remind everyone what the all-time high was.
The all-time high back in October 2025 was $126,000.
So we are down roughly 50%. That's a coin flip. Heads you're rich, tails you're well, you're hurting.
Depending on the day you check, it's somewhere between 45 and 52% off the highs.
Yeah.
And that is a painful drawdown. It's the kind of thing that shakes people out. It tests your conviction.
And Strategy Inc.'s stock ticker MSTR is down even more, right?
Oh, much more. It's down 70% from its mid-July all-time high of $456.
Ouch. That's visceral. That's the kind of drop where you just delete your brokerage app off your phone and pretend stocks don't exist for a few months.
It is. But here's where the analytical perspective has to override the emotional one. You've got to zoom out. We're looking at research from analysts at places like Bernstein and Standard Chartered, and they're looking at this not as the end of the cycle.
But as what?
As a necessary correction before the next leg up. They're still, even today, predicting a rally to $150,000.
So the thesis is that the bull market isn't dead, it's just taking a nap. A very scary, volatile nap.
Well, nap might be a bit too gentle. It's more like a stress test for the whole market. The market is purging the leverage. Bernstein isn't just saying hang on. They're arguing that the structural demand from the ETFs hasn't vanished. Not at all, despite the price drop.
The plumbing is still there.
Exactly. The pipes are still there. The water pressure just dropped for a moment. They see this as a consolidation phase before the next major institutional wave comes in.
And in the middle of this pressure drop, Strategy Inc. isn't acting like a panicked trader. They're acting like what they call themselves now, a Bitcoin development company.
I love that branding.
Me too. It sounds so industrial, like they're building bridges or power plants, but with digital code.
In a way, they are. They are the first global implementation of this corporate treasury model at this scale. They aren't just a software company anymore. Let's be real. They are a holding company for a massive asset base.
And that asset base is?
Specifically, a treasury of 714,644 Bitcoin.
714,000. It is just a staggering number to say out loud. I mean, we talk about whales in crypto. This isn't a whale, this is the ocean.
It's the digital fortress, as Saylor calls it. And the key to understanding if this fortress can survive an $8,000 price tag isn't just looking at the size of the Bitcoin stack. You have to look at the architecture of the fortress itself. How is it built? What are the walls made of? Because if the walls are weak, it doesn't matter how much treasure is inside. A strong wind will knock it over.
That's a great point. Which brings us to the architecture. Let's unpack the capital structure. Because Strategy Inc. doesn't just have, simple loan from the bank. They have built this really complex, tiered hierarchy of liabilities.
I call it the Bitcoin-backed yield curve.
Yeah.
And it is a fascinating piece of financial engineering. The most critical thing for you to understand is that, unlike traditional corporate debt, which has a maturity date.
A day of reckoning.
Exactly. A specific day where you have to pay back the principal or you go bankrupt. Strategy Inc. has moved heavily into perpetual instruments.
Perpetual. Let's pause on that word because in finance, words usually mean exactly what they say. Does perpetual really mean forever?
It means no maturity date. There is no maturity wall, as they call it. In a traditional crisis, think back to the 2008 financial crisis, companies fail because a bond comes due on a Tuesday, they don't have the cash on that Tuesday, and the lenders force them to sell assets at fire sale prices to pay it back.
Forced liquidation. It's the nightmare scenario for any CFO. That's the death spiral.
Exactly. Perpetual instruments eliminate that specific trigger. You still owe the interest or the dividend. Yes, you have to make those payments, but you never have to pay back the principal on a specific Tuesday. It gives you the option to wait out the storm.
Okay, so let's look at the tiers of this fortress. Tier 1 at the very top is the convertible debt.
And the interest on this is incredibly low. The weighted average cost is something like 42 basis points.
Okay, for anyone who's not a bond geek, break that down. 42 basis points is
0.42%.
That is basically free money. I mean, how do they get a loan that cheap when mortgages are at 6 or 7%? Who is lending them money at less than 0.5%? It seems insane.
It's not charity. It's the convertible part that's the key. A convertible bond is a hybrid instrument. It's a bond that dreams of being a stock one day.
I like that.
The lender accepts a tiny, tiny interest rate because they get an option. If the MSTR stock price skyrockets, they can convert that debt into shares and make an absolute fortune on the upside. They're essentially paying for that lottery ticket by accepting a lower yield today.
Ah, I see. So the real cost to Strategy Inc. isn't the interest payment, it's the potential dilution of their shares down the road.
Precisely. They're paying with future equity, not with current cash. Then you move down a level to Tier 2. This is the mezzanine layer. This is where the preferred stocks live. They have these cool tickers like STRF, STRC, STRK, STRD.
Right. Perpetual strife, perpetual stretch, perpetual strike, and perpetual stride. It sounds like a list of gladiator names. Or maybe the 4 horsemen of the financial apocalypse.
Or the stages of a really intense CrossFit workout. But for today's deep dive, we are really going to focus on STRC perpetual stretch. This is the one that's getting all the attention. It has a variable yield, currently paying out 11.25% with monthly cash distributions.
11.25% is a very juicy yield in this market. If you're a retiree used to getting, 4% from a Treasury bond, 11% looks like a steak dinner every night.
It is very attractive.
Yeah.
And it's designed to be. And then finally, at the very bottom, Tier 3, you have the common stock, MSTR. This is the residual equity. These are the people taking the most risk for the most potential upside. The shock absorbers.
Okay, so that's the structure.
Yeah.
But we mentioned the cash firewall earlier, that $2.25 billion. If we're assuming in our stress tests that this cash goes to zero, we first have to understand what it's doing right now.
Right now, that cash is the life support system. It is the war chest. Its entire purpose is to meet all those recurring obligations, the interest payments, the dividends, without ever having to sell a single Bitcoin.
Because the moment you have to sell Bitcoin to pay the electric bill, you're violating the prime directive of the entire company. The whole thesis is you never sell.
Correct. You never, ever want to be a forced seller in a down market. So let's look at the burn rate. The total annual liability for Strategy Inc. is around $888 million.
Nearly $1 billion a year just to keep the investors happy and the lights on. That is a heavy, heavy burn.
It sounds heavy, but let's break it down. You've got about $35 million of that going to the convertible debt interest, which is peanuts, really, thanks to that 0.42% rate we just talked about.
Right.
But the big chunk, the main engine of the burn, is the cumulative preferred dividends. That's about $713 million a year.
Yeah.
And then you've got another $140 million for the non-cumulative dividends.
Okay, so you have $2.25 billion in cash, and you're dividing that by, let's call it roughly $900 million a year. That gives them about 2.5 to 3 years of runway.
Exactly. That cash buys them time. It buys them survival. If Bitcoin goes into a brutal bear market for 2 years, they just burn the cash, they keep paying the dividends, and they wait for the sun to come out again. They don't sell the Bitcoin.
But in our scenario, the nuclear winter scenario, we are assuming the sun doesn't come out for a long, long time. We are assuming they burn all of that cash, it's gone, and Bitcoin is still at $8,000.
That is the test. But before we can run the numbers on that test, we have to factor in the huge new variable, the news that just broke this week, the strategic shift to equitize the debt.
This is that $6 billion move that Saylor was talking about on Fox Business.
Yes. The plan is to convert $6 billion of that convertible debt into common equity over the next 3 to 6 years.
Okay, let's just pause there and make sure we really understand why this is so important. Why take debt and turn it into equity? Why is that a good thing for the company's stability?
It massively deleverages the balance sheet. Think about it. When you have debt, you owe money. You are a debtor. If you don't pay, they can sue you. They can force you into
There's
bankruptcy.
no legal obligation.
A very strict one.
Yeah.
But when you have equity, you have partners. You don't owe a shareholder their money back in the same way. By converting that debt into equity, Saylor is removing the sword of Damocles that hangs over most companies. He is taking $6 billion of hard obligation and turning it into flexible ownership.
It makes the company safer. It reinforces the walls of the fortress. But here's where I get a little stuck. You have to put yourself in the shoes of the bondholder.
Right.
Why would they agree to this? If I hold a bond, I have a contract, you owe me my money back, I'm first in line if things go bad. Why would I ever trade that safety to become a common shareholder in a super volatile company?
That is the billion-dollar question. And this is where we have to get into the psychology of the institutional investor. The research we've seen points to a win-win argument that is driving this whole thing.
Okay, what's the argument?
First, there is the concept of the NAV discount, the net asset value.
Explain that for us like we're 5.
Okay, think of it like buying a house. Usually you pay the market price for a house, but imagine a house that's literally made of solid gold bricks.
Okay, I'm with you.
The value of the gold in the bricks is worth $1 million. But for some reason, the house itself is selling on the market for $1.5 million. That's a premium. You're paying extra for the structure, for the fact that it's a house.
Got it. And MSTR usually trades at a premium like that.
Correct. People pay more for the stock than the underlying Bitcoin is worth because of the corporate structure, the liquidity, etc. But recently, that premium has compressed. It's getting very close to 1-to-1. And sometimes it is even traded at a discount.
So using the house analogy, the gold bricks are worth $1 million, but the house is selling for $900,000.
Exactly. So if you're a bondholder, converting your debt to equity right now is like getting a coupon to buy Bitcoin on sale. You are swapping your safe debt for shares that are mathematically undervalued relative to the assets they hold.
Yeah.
You're getting exposure to the underlying Bitcoin at a discount.
Okay, that makes perfect sense. Who doesn't love a discount? It's basically a free arbitrage opportunity.
It is. Second, you have to consider where we are in the cycle. We mentioned the cycle bottom theory. If you hold a bond, your return is capped. You get your tiny interest payment, and that's it. You have zero upside if Bitcoin moons.
Right, you're just a lender.
But if you believe that Bitcoin is going to $150,000, you don't want a fixed tiny return. You want the upside. You want the 2x or 3x gain. You want to participate in the rally.
So it's FOMO. Fear of missing out. Even the big, stuffy institutional guys get FOMO.
Institutional FOMO is the most powerful force in all of finance. If their competitors are buying Bitcoin and making a fortune, and they're stuck holding a 1% bond, they look like idiots to their investors. They'll lose their jobs.
Yep.
And finally, there's the bigger macro rotation that's happening. The research highlights this gold to Bitcoin rotation. Gold hit $5,000 an ounce in 2025. A lot of investors are sitting on massive profits in gold. They're cashing out and looking for the next undervalued hard asset to rotate into.
And since Bitcoin is down 50% from its highs, it looks like the undervalued play.
Precisely. They are selling high on gold and buying low on digital assets. Converting that MSTR debt to MSTR equity is a clean, simple way to ride that rotation without having to go out and set up a Coinbase account and deal with self-custody.
Yeah.
They just swap the paper.
Okay, so the bondholders are incentivized to switch. The company wants them to switch to reduce debt. The stage is set. The debt is, for the purposes of our model, effectively gone.
It's gone.
Now, let's break the model.
Let's break it.
Section 4, the nuclear winter stress test. We are rerunning the waterfall. Here are the parameters. 1, the spent cash rule is in full effect. We have $0 in the bank.
0.
2, the price of Bitcoin crashes to $8,000.
And just to pause there, $8,000. That is a drop of roughly 88% from where we are today. That is a cataclysm. It's an extinction-level event for most of the crypto industry.
It's the end of the world as we know it. Okay, parameter 3, the asset value. At $8,000 per coin, with those 714,000 coins, the total treasury is worth roughly $5.7 billion.
5.7 was $7 billion, to be precise. That is the entire pot of gold we have to distribute to everyone who is owed money. That is the whole pie. There's nothing else.
Okay, so imagine a waterfall. The money flows from the top down. Who is standing at the top with their bucket? Who gets paid first in a liquidation?
Priority 1 is always the senior debt. But remember, we just discussed the big equitization plan. If they successfully convert that $6 billion of debt into equity, there isn't actually much debt left in this top bucket.
How much is left, according to the research?
The research estimates only about $240 million of unconverted debt remains in this scenario.
240 million, and we have 5.7 billion in assets.
So bucket number one is overflowing. The remaining debt holders get paid back 100%. Not a problem. The water flows right over them and down to the next level.
Okay, next in line, who's that? Priority 2A.
Priority 2A is STRF, the senior preferred stock. Their total claim is roughly $1.36 billion.
All right, so we've paid out $240 million already. We've got plenty left in the pot.
Plenty. So we pay the $1.36 billion to the STRF holders. They are 100% covered. They get all of their money back. No issues.
Now we get to the star of today's show, the security everyone is watching, Priority 2B, STRC, the perpetual stretch.
This is the big one. The claim here is about $3.4 billion. This is where the tension lies. Is there enough water left to fill this bucket?
Okay, let's do the math live. So we started with $5.717 billion. We paid out $0.24 billion to the debt holders. Then we paid out $1.36 billion to STRF. That's a total of roughly $1.6 billion gone. So 5.7 minus 1.6, that leaves us with about $4.1 billion left in the pot.
And STRC only needs $3.4 billion to be made whole.
So they get paid.
They get paid. Full stop. 100% covered.
Even at $8,000 a coin, with zero cash in the bank.
Even at $8,000 a coin, with zero cash. If you add up all the senior claims, the debt, the STRF, and our focus, the STRC, the total comes to exactly $5 billion.
And the assets are worth $5.717 billion.
Which leaves a surplus.
A surplus of roughly $717 million.
That's right.
That is genuinely shocking, honestly. We are talking about an asset dropping nearly 90% from its current price. The company has burned through all its cash, and there is still $700 million left over after paying off the key preferred shareholders.
The math is the math. It creates a collateral ratio of roughly $1.16 of Bitcoin for every $1 of senior claim. Ugh. It is a fortress. And the walls hold?
But wait a second. We have to talk about the losers in this scenario. Because money doesn't just appear out of nowhere. If the preferreds are safe, who is taking the hit? Who pays the price?
The people standing at the very bottom of the waterfall. The junior preferreds, that's STRK and STRD, and of course the common stockholders, MSTR.
The MSTR brews.
In this scenario, with Bitcoin at $8,000, the water runs out before it ever gets to them. They would likely be completely wiped out, or maybe receive pennies on the dollar from that $700 million surplus, but effectively their investment goes to zero.
So the common stockholders are effectively the human shields for the preferreds.
That is a stark way to put it, but in financial terms, yes. They are the insulation, they are the first loss capital, they are taking the ultimate risk. By buying the common stock, they are effectively making a statement. They're saying, we will absorb all the volatility so that the STRC holders don't have to.
It puts the MSTR bros in a whole new light, doesn't it? They aren't just gamblers on the price of Bitcoin, they are the structural foundation that allows the smart money to come in and buy the safe, high-yielding paper.
That is exactly how the capital structure is designed to work. It parses risk into different buckets. The common shareholder is buying a levered bet on Bitcoin. If Bitcoin goes to $150,000, they make an absolute fortune. But the price of that potential fortune is the risk of total loss at $8,000.
Okay, let's drill down a bit deeper into this STRC security. Let's call this Section 5, because you mentioned a surplus at $8,000. If there's still money left over there, where is the actual breaking point? What is the concrete floor?
Okay, good question. If we run the math backwards to find the exact break-even point, the price where assets equal liabilities exactly down to the penny, the solvency floor, is actually around $7,000 per Bitcoin.
7,000. So that is the real line in the sand.
That's it. Mathematically, the STRC principal is protected all the way down to $7,000. Anything above that, and the holders get their full $100 par value back in a liquidation.
That is incredible. But I want to clarify something for the listeners, because I know this trips people up every single time. We're talking about par value and liquidation preference. But if I open my brokerage app, STRC trades at a price. And that price moves. It might be $98 today, $95 tomorrow. How does that relate?
That is a crucial distinction. The trading price is simply what you can sell it for today to another investor in the secondary market. The par value is what the company contractually owes you if they liquidate the business. STRC has a $100 par value.
But what keeps the trading price from just collapsing if there's a panic? If Bitcoin crashes 20% in a day, wouldn't people panic sell STRC down to $50? If I see Bitcoin tanking, my first instinct is to dump everything even remotely associated with it.
They might try. But Strategy Inc. has built in a very clever stability mechanism. It's essentially a yield hike. It acts like a thermostat for the price.
Okay, how does that work?
The rules state that if the trading price of STRC drops below $95 and stays there for a period of time, the dividend rate automatically increases. In fact, they recently raised it from 11% to 11.25% for exactly this reason.
Ah, I see. So if the price drops, the yield gets even juicier for new buyers.
Exactly. It lures buyers back in. Think about it from a fund manager's perspective. If the stock drops to $90 and the yield cranks up to compensate, suddenly you are looking at a 12 or 13% effective yield on an instrument that is secured down to $7,000 Bitcoin. Smart money steps in.
The arbitrage funds.
Hedge funds, pension funds, family offices, they buy that dip to capture that enhanced yield. That buying pressure then pushes the price back up towards par.
It's self-correcting. If the room gets too cold, the heater kicks on automatically.
Precisely. This mechanism makes STRC behave less like a volatile tech stock and more like a short-duration credit instrument. It's designed to strip away the wild volatility of Bitcoin, but lets you keep the high yield. The goal is for it to trade flat, right around par, regardless of what the crypto market is doing, as long as Bitcoin stays above that $7,000 floor.
Okay, so let's zoom out to the conclusion and the bigger picture. Section 6. We started this entire deep dive asking if the Saylor claim was true. Is the company solvent at $8,000?
And the research is definitive. Yes,
Yeah.
The claim holds up. Strategy Inc. remains solvent at $8,000 Bitcoin, even if, and this is the key correction from our last deep dive, even if they burn through all $2.25 billion of their cash first.
The combination of that massive Bitcoin stack, the 714,000 coins, and this new aggressive plan to turn debt into equity, it really does create a concrete foundation. It's hard to argue with the math, even if you hate the underlying assets.
It does. And, it leads to a really interesting theory that's floating around in some of the research we look at. They're calling it the central bank theory.
Oh, I like the sound of this. It sounds grand. It sounds a little conspiratorial, but in a financial way.
Well, think about what Strategy Inc. is actually doing here. They hold a hard reserve asset Bitcoin, the so-called gold for the digital age. And against that reserve, they are issuing their own liabilities, their own currency, if you will, in the form of these equity and preferred shares.
So MSTR common stock and STRC preferreds are basically like banknotes that are backed by the Bitcoin in the company's vault?
In a way, yes.
Hmm.
They're acting like a private central bank for the digital age.
Okay.
They're managing their money supply, which is their shares. They're managing their reserves, which is the Bitcoin. And they're managing the interest rates, which are the dividends. They're doing everything the Federal Reserve does, but it's privatized. And it's backed by a provably scarce asset rather than by government decree.
That's an audacious vision. It's rewriting the rule book of what a corporation is supposed to be.
It is incredibly audacious, and it's incredibly risky for the common stock. We cannot stress that enough. If you own MSTR Common, you are leveraging the volatility to the moon. You're the tip of the spear. But if you own the preferreds,
You're sitting safe and sound in the fortress.
you are sitting in the fortress, watching the storm rage outside, collecting your monthly check. You are insulated by the layers and layers of capital below you.
It's funny, we spend so much time in the space debating if Michael Saylor is a madman or a genius, but maybe the real genius is creating a financial structure where he can be a little bit of both, and the structure still survives the apocalypse.
That is the beauty of financial engineering when it is done right. It separates risk into buckets and lets people choose their exposure. The gamblers get the gamble they want, the savers get the safety they need, and the machine keeps on running.
So as we wrap up here, I want to leave the listeners with a final thought to chew on. We talked about the MSTR bros, the common stockholders.
The human shields.
Right. Are they just gamblers? Or are they visionaries? Because by taking that massive bet, by buying the common stock that could in fact go to zero if Bitcoin hits 7,000, they are effectively subsidizing the safety of the STRC holders.
They are creating a public good in a financial sense. They are enabling the very existence of a high-yield, tax-deferred, bond-like equity for the rest of the market to use. Without the MSTR bro taking on all that risk, the STRC saver couldn't exist in this form.
It's almost like, I mean, would it be wrong to call STRC a Strategic Treasury Reserve Certificate?
I like that. That has a nice official ring to it.
It sounds like something you'd buy from the government, right? But instead you're buying it on the NASDAQ. It's got SBIC insurance. It's fully tradable, and it's backed by the largest non-governmental Bitcoin treasury in the world.
You have to ask the question, are we watching the invention of a totally new asset class right before our eyes? A Bitcoin bond that isn't actually a bond. It sort of bridges the gap between the chaotic Wild West world of crypto and the orderly, predictable world of fixed income.
That is the question we want you to mull over. Is this the future of corporate finance? Or is it a singular anomaly that only worked for this one company, with this one CEO at this one moment in time?
I have a feeling we will see others try to copy this model. But catching up to 700,000 Bitcoin is going to be a very, very tall order. The moat is very wide.
A very tall order indeed. Okay, before we sign off, we have to give a massive shout out to you, our community. This deep dive, and specifically the correction on the cash model, it would not have happened without you.
Absolutely. To the listener who took the time to write in and point out that double counting error, thank you.
Oh.
You made this analysis better. You made it tougher, more rigorous. And that is what this show is all about. It's a collective intelligence. We are just the guides here. You guys are the scouts on the ground.
We are analyzing this stuff in real time. The story is still unfolding as we speak. So please, if you are a finance expert, a crypto native, or just someone who loves crunching numbers in Excel, check our model. Tell us where we are wrong. Leave a comment. Challenge us.
We want to hear from you. We're always looking for collaborators.
And if you are enjoying these deep dives, if you like getting into the weeds with us, please subscribe to the show. We are on Spotify, Apple, YouTube, fountain.fm, anywhere you get your podcasts that supports Podcast 2.0.
And we have a very specific goal right now. We are trying to hit 1,000 subscribers on YouTube.
Yes. That number is magic. It unlocks funding for the Mosaic AI video editor. And let me tell you, this tool is going to change the game for us. It'll allow us to create automated clips, infographics, AI, B-roll. It will turn these audio deep dives into a full visual experience.
So if you want to see the waterfall model we've been talking about, not just hear about it, hitting that subscribe button on YouTube is the best way to help us get there. It helps us produce better content for you.
And for those of you interested in the real nitty-gritty of STRC, like how to use it as an instrument for early retirement, the tax benefits, and so on, we have a link to our YouTube course on that very topic in the show notes. It is a goldmine of information if you want to go even deeper.
It's definitely worth a look if this topic interests you.
All right. I think that's it for today. Bitcoin at $8,000. The fortress stands. The cash is gone, but the foundation holds.
It's been a pleasure unpacking it.
As always, keep searching. Keep the quest on.
See you next time. I'm Satoshi.
And I'm Satoshi.